Okay, my guest today originally hails from the West Coast, a true Southern California girl. When it came time for college, she signed with Indiana State University to play Division I college softball. In 2007, after graduation, she moved into the banking world, which has ultimately led to her current position as a mortgage loan originator for American Mortgage. She currently resides in Bluffton, Indiana, with her husband Matt and her 3 crazy boys. In her free time, if you don't see her at the ballpark, you will find her somewhere in the community, as she has made it her personal goal to be active and involved in the area she lives and works in. Everyone help me welcome Jessica Best.
Thank you.
How's it going?
That was awesome.
Right?
Nailed it. That was really good.
So the first thing I want to know is, you moved from California to Indiana.
Yes.
Tell me why. Did you ever go back to California? So just turn back that clock with me and talk to me about how you got here. Tell me your school history, your work history.
Okay, so born and raised in Southern California. It's actually a town called Sunland, Tahunga, which is super weird to spell and say fast. My dad was a single dad, and just me and my sister, and he was trying to find something for us to do to keep us busy, so he got us into softball, me and my sister. And we both did really well at it, and so yeah, we stuck with it. Was recruited early in my high school year, and I kind of just decided I was not staying in California.
Yeah?
Truly, like I meant to actually leave California. It was my mission to go somewhere else. I did not originally want Indiana. I wanted to be somewhere warm. Snow freaked me out, but I chose Indiana State. I'll be honest, like when I took all my trips and I visited Indiana State, they were the most welcoming, the kindest people. I was like, okay, so if I'm gonna leave home and not be around family, I at least wanna be by people who want me here, who were super nice and welcoming. I was like, okay, let's do it. And my dad was like, Jessica, are you seriously going to Indiana? I'm like, I really am. I'm gonna do it. Yeah. And I loved it. And so I met my husband. It was my freshman year. So yeah, I met him and moved up here, and then I went into Markle Bank to actually open up a checking account since we were moving up here. And they were like, hey, so what's your degree? And asking me some questions, and I was kind of giving them some answers. I was a wreck. I had just moved in, like just trying to open up my account, and they ended up offering me a job that day. I was like,
Markle
this
Bank.
is great. Like, okay, if this is how it works, great. And it was the best place. It was like a dream to work there. They showed me everything in the banking world. It was awesome. And that opened my eyes to mortgage lending, and I really never turned back. I just full force went into it. It was awesome.
So you went to school for what? What? Exactly?
My actual degree is in finance and what is that? It's like management, but I forget. There's like a long title for it, but management and finance. Yeah.
So was banking your originally
Zero
plan?
chance. I had no idea banking was good. Never considered banking. I thought for sure I was either going to go into teaching, like at a high school level, and do business education, or I was going to work at a finance company of some sort. And I'm really, I kind of like the backroom side of it, where I audit and things like that. So I really thought I'd have a career in auditing, and I did that while I was at the bank for a while, and I didn't hate it, but I also was like, you know what, I have an interest and a like for people more. So I think I'm meant to be more in front, not such backroom staff. And I just really like people. So I talk too much to be in the back room. I'm too chatty, so I belong out in the front. I belong in sales.
So that's pretty crazy. You just kind of fell into this job, and you've been doing it ever since then.
Yeah. Angie Top came to Markle Bank, and she's just known in the community and such a great lender. And she kind of snagged me and was like, hey, you can do this. Like, this is something for you. I'm like, okay, what can I do? Went through the whole process of learning how to take an application. She just sort of walked me through it, and I stuck with it.
So that's something I didn't know. You talked with Angie at Markle Bank. She was at Markle Bank, and she said, hey, maybe you'd be interested in this.
Yep. She's like, you would be really good at this, Jess. And I thought, oh, yeah. I mean, I love lending. I was a commercial lender, and I did home equities already. She just kind of walked me right through it. And at the end, I was like, yep, this is exactly what I'm supposed to be doing.
So Markle Bank, you started there. Then where did you go after that?
I came directly. Okay, so Markle was sold. It became IAB. Yep. And so after that transaction happened, it was fine. It was a great place to work. But she ended up opening up this office with American Mortgage, and I was just like, you know what, I'm diving in. I'm going with Ange. It was a really big step because the bank was great to me. I really loved everybody there. But this was the career that allowed me to have that work-life balance where I had 3 boys. I want to still be able to do the mom stuff, set my own calendar, and schedule. And so this is what just worked out. It was the best decision I have ever made, and I would never turn back. It was great.
I'm sure that was a little bit scary leaving security of a bank to say, hey,
because this is commission only.
Let's go.
So yeah, I left salary for commission only, and I was just gulping my way through it. Like, you can do this, Jess. You got it. And I did, yeah. It was scary though.
Didn't ever look back.
It was for sure scary.
Yeah. Okay, I don't want to forget about this part. iPhone or Android user?
Oh, iPhone.
iPhone. Yeah. How about your husband?
iPhone.
iPhone family.
We need simplicity. We're not techie.
Right.
We need simplicity.
I like to. Everything just falls into place. So.
Okay.
Cable, Netflix, Hulu. What do you watch?
I'm Hulu. The rest of my family's Netflix.
Yeah. Hulu because you like to watch the new shows but don't want to record them, or
exactly.
Yeah.
Yep. I just don't have time to watch them when they're really on. So I have got to come back after everyone's asleep, and I've cleaned my house up for the night, and I've got my time. Everybody else in my family seems to love Netflix. So.
Any particular show or series you're watching?
For me, I have been really watching that Handmaid's Tale, which is crazy, but it's really good. And then I really like Yellowstone.
Yeah, I do
Yellowstone.
too. I do too.
Yeah.
That should be coming back any day, right?
I can't wait. Yeah.
Me too. Okay, let's dig in. I know your heart is helping people out, and what better way to help somebody than to guide them through the biggest purchase of their life?
Yeah.
So start by walking me through how that process starts for someone. If I was ready to buy a house today, my first house, what can I expect? Talk to me about those first steps and what goes on.
Okay, so a lot of people now seem to be on the track where they understand that their credit matters tremendously. So I tend to get phone calls now, which 3 years ago was a little bit different, but now I tend to get phone calls where they're like, hey, I want to get prepared. What can I do? Which is the exact right thing to do. So we want to take a look at the credit. It doesn't necessarily mean I have to pull it. Sometimes, there's a lot of sources out there where they can take a look themselves. But we want to make sure that there are no recent past dues. They have enough credit actually established to show an actual score, okay? We want to make sure that they understand, you need to have some money in the bank. Maybe it's not for your down payment, but you do need to have some established money set aside so that you've got, there's things that are going to happen when you move in, things you're going to want, need. And then we want to talk about employment. So employment's a really big deal. A lot of people, there's overtime out there, there's bonus structures, salary versus commission. There's just a lot that varies in your income. So if they call me ahead of time, I can find out how they're paid, how it's structured. Is a bonus structure something they want me to take into consideration? Because I'm pretty conservative. I won't unless I need to. Being house broke is not something I ever want for any of my clients. So we take a really good look at all of that, and that picture gets them an idea of what they're really comfortable with when it comes to a monthly payment. I estimate taxes and insurance in that for them, and that's literally a part of our first conversation. That way, when they're done talking to me, even if I don't necessarily have credit pulled, I want them to know what they feel comfortable with for an actual mortgage payment when they leave the phone. When they hang up and they probably have a list of things I'm having them work on doing, I want them to know, like, hey, at the end goal is like light at the end of the tunnel. I may have a lot of things I got to work on, but I want them to know like what their final payment's going to look like so that they feel really comfortable and excited about it. And it is a lot less expensive to buy if you look at a monthly payment structure versus a rent structure, but that does not mean they're all ready to buy. That doesn't mean everyone's ready to be a homeowner. But again, light at the end of the tunnel, it gives them something to work for.
Right. So you said, and not everybody is always ready to buy a house, and sometimes specifically that is because of their credit or because of their savings. So, so that's not for everybody. But talk to me about the things that I could do to get my credit score up. And I know you just said something about other sources than you to pull their credit. So tell me or tell everyone where they could go to find out their score, what kind of score they need to have, and talk to me about those.
Okay, so let's just talk about the actual score. So we want somebody with 620 or over. Really, we want them with 640 or over, but 620 or over does qualify for some products, okay? So we want to take a look at where their score is, but those other sources out there that they can use, so there is Credit Karma. It is not a credit, it's not a credit agency. So those scores are not going to be exact, but what they do a good job of is at least reporting what's reporting on their credit. Like, is there a collection that's been recently put out there? Maybe they paid a credit card off, and they want to see that balance go down to zero or whatnot. Credit Karma does do a good job of reporting current stuff, okay? Discover credit cards. A lot of the credit cards out there show you your FICO score as well, but what it does is it shows you, again, what's reporting currently on your credit. That's important. It may not give me the score that I need right now, but it does give me an idea. And if it shows a past due, I can tell them right then and there, we're going to need to wait. If you're trying to do a certain style loan, you're going to need to wait a year, because there are certain loans out there that will not let you move forward if you've had one recent late payment. They're pretty strict, some of them. So I can tell them right then and there, here's our timeline. We're going to have at least 5 months, 6 months, a year, whatever it is. Student loans. I can get an idea from them what their student loan balances look like, because a lot of people are in the deferment right now, the zero interest. We know what's going on with that. But that doesn't mean we don't calculate a payment against them. In the mortgage industry, we're doing the worst case scenario of mostly everything financial, right? We want to make sure that even if they have the highest payment, they can still afford their home.
Right.
So we do calculate, it's 0.5% or 1% of their actual balance. So if they have a $20,000 student loan that they're paying nothing on, they come to us saying, oh, but I don't have a payment on that right now. Yeah, but you will eventually, so we do have to add one in. So anyways, that gives me a good idea, of what I have to calculate for them in terms of their debt to income. And then the other thing that those credit scoring agencies do is, again, it tells me if they've had other collections or anything like that they need to take care of. So medical collections are not required to be paid off prior to buying, but any other collection is. So like Mediacom, Verizon, like those are some of the basic ones we see. Those have to be paid to zero. They have to be closed out and taken care of. So it gives us a good idea of that. And if the folks don't have credit, hey, I don't have anything, I don't pay on anything, that also tells me what they need to do. They need to open up something in their name. There has to be something that you show an established payment on. Okay, so a lot of times.
Is it even a credit card?
Credit card, yep. I always recommend people get something that you will use, but not overuse. So, gas card or something like that, right? But you do need to get in the habit of paying it off. And that's a conversation that we really do have to have, actually. So yeah, it gives us a really good idea, a picture of what is needed to get their credit established. Now, I will also say there are loans out there available for folks who have zero credit. That does exist. It is a lot harder to do, and they do have to show assets, which means they do have to put some significant money aside in order to do it. And then there's some things we can use to verify that they've made payments on time, such as rent verification. Maybe they have their auto insurance that we can verify. We've done that. Just things like that we can show.
So you talked about a minimum score of 620 to qualify for a basic loan, but you'd really like to see it over 640. So something like Credit Karma could give them an idea of where they're at to start with, or if they have to work on a few things. You talked about debt to income, though. Tell me about debt to income and what that means, so how someone could figure out if they even qualify.
Yeah, so we take every payment that they will make throughout that month, okay? Their auto payment, their student loan payment, again, we calculate that for them, what that would be. Their rent or whatever, we take all of that into consideration, and then we divide that by how much they make monthly, okay? That gives us our debt to income ratio. 45% is the highest. We really don't want someone at the top of that range. That means that it's going to be tight for them. So we try to get people within that 30 to 35% range. And, sometimes that's a conversation of just saying, hey, if this credit card balance is really high, let's get this paid down over time so you're not buying a house with the highest payments possible. Let's make sure we're getting you in a really good spot. Or if they just don't have enough credit, then their debt to income looks like it's nearly zero with, then we add in the mortgage payment, of course, which is going to be new for them. But that's not a bad spot to be in, but the problem would be that they don't actual credit to show. So then in that case, their debt to income would be lower. But yeah, we just take their monthly debts and divide it by their monthly income.
So you say 45%. So it's slightly less than half of your monthly
Yes.
income can go towards
Right.
bills that you have already.
And we use gross income. So we use the income that is, prior to taxes and insurance and all those things that come out. So really, we know what our paychecks come home are not exactly what our gross income is. So that's another thing to take into consideration. Yeah.
Okay, so let's talk about different types of loans. I'm going to ask you about several different types, but let's start with an FHA loan. I hear a lot about these type of loans. Describe to me what an FHA loan is and what that actually means.
FHA is Federal Housing Administration. It's a federal government style loan, okay? So it allows the buyer to put down 3.5% of a purchase price. It's a limited down payment loan. What it does really well is it limits with a fixed calculation what their PMI will be. And that's a really big deal. So somebody with credit probably 700 and under, FHA is going to be a great product for them because that PMI monthly is going to be pretty low. It's going to be fixed. It's a calculation. It's a little bit longer to explain, but basically it's their credit puts them in that range, right? And then that calculation based on the amount of the loan is their fixed PMI. That is a really good thing for some of those folks in that credit range because it keeps their payment very affordable. The other thing that FHA does really well is they keep really low rates. So it's a really good product, especially for a first-time home buyer, but it can be used for anyone at any time. But it's just a really good product to get somebody in. It has a downside. It has lifelong PMI. So that PMI is going to be low, but they're not going to drop it off. Some loans can drop off after 11 years, and other ones it stays on there. So you just kind of have to weigh out your options and what works best for the buyer. But FHA is a great product.
So you say that FHA is a government loan. What about a USDA loan? That obviously sounds like that's a government loan too.
It is as well. There's some backroom things where one of them is backed by the federal government, one is not. That's not important. But what is important about a USDA loan is that it's zero down. So it's another good product for somebody who hasn't maybe put enough aside to put a down payment down. That PMI is fixed as well. It's a higher fixed rate of PMI, but it still does a great job. But what the USDA does is it adds an upfront funding fee that no other product really does. So they do that to limit that PMI that they're going to charge you as well. They also keep reduced rates, so rates are lower than what you're going to get in a conventional loan. So the good thing is it allows zero down. It does limit the PMI that can be calculated, but the zero down is the big trigger. I mean, that's the big boom for everybody who wants that product. There are some tricks to that product. You can't have over a certain income. They're really picky on household income. So if you're having someone else live in the house with you, they ask a significant amount of questions up front to make sure that they know what kind of household income is in there. So it can be tough, but it's still a great product for somebody who does not have the funds to put down.
So you say a USDA loan does household income verification, even if they're not on the loan. They want to know.
And that is tricky because that is frustrating for somebody who says,
sure.
I'm not on that loan. I still have to ask for income verification to prove what they earn, and that will disqualify them if they're over that income limit, even if they're not on that loan. It will disqualify them. The USDA is interested in one thing: home ownership for people who need it. So they're bringing that household income in so that it's not an open product for everybody. Those funds are limited. It's not for every single buyer in this country. It is for those in a rural area who need assistance by way of not asking for a down payment. But if you're making a couple $100,000 a year, you're not qualified for a USDA loan. You have the assets to put down, or you have the income to establish the assets to put down. So it's really a product that's bookmarked for people who need the assistance.
Okay, so I heard you say FHA is 3.5% down. A USDA could be 0% down, but both have PMI. Talk to me about PMI. What does that even mean? Yep. And why do I need that?
Private mortgage insurance is what PMI is. Okay, so it is not insurance that covers your property. It does not cover you. It is scheduled, or it is in your monthly payment as a protection for your failure to pay. It's not going to come in and save you if you're behind. What it's going to do is it establishes an insurance, basically a book of insurance for folks who do not make their mortgage payments and foreclose on a home. That comes in and hopefully fills the gap for banks who are willing to buy those zero down loans. They're riskier loans. If you think about it, if you're not putting anything into it, they look at that and they say the risk is higher for non-payment. So the PMI really is just established as an insurance book of insurance to basically cover those who do not make their payments, and the banks don't want to go in the red on those. Foreclosures, what happens. It typically does not come in at the price or the value. So that PMI is there to help banks want to hold those loans.
So just a cost
and
to
so it
secure
has
that loan.
And so that is why the risk is there. The risk structure is there when they quote PMI. So we'll get into that a little bit later on conventional, but that is why they charge you that fixed rate, so that it is established for you. It's not going to go up for you or down. It's going to stay the same, and consistency is key when it comes to making their mortgage payments. They're fixed rates. Their fixed PMI, it is not going to change their payment. So that is why we have to do a really good job up front, making sure that that payment works for them, so that there's not going to be a non-payment issue. But yeah, that's what it's there for. If you have 20% down, you pay no PMI. So there is a way to get out of PMI. But those two loan products, if you're in those loan products, it's because you don't have 20% down.
I understand. So VA is there just for military people. Tell me about VA loans.
Yeah.
What benefits they have for our military, and can you do those?
Yep. Yeah. Oh yeah, absolutely. So we are a preferred lender for any of those options. So FHA, USDA, VA. VA is awesome. And what they are so good at is when they offer the zero down option for vets, they can put money down, that's fine. But they do not charge PMI. So it is the only product out there that does not have PMI. But they also do that upfront funding fee in a way. They also have a VA funding, what's called a VA funding fee. But here's the deal. That can be waived if the vet has even a 10% disability. So that could anything, hearing loss, like it just depends. So the VA does a really good job of being accommodating to that. They're tough when it comes to the appraisal. There's some triggers there that the VA doesn't have a great reputation for. But bottom line is they offer a zero down loan with no PMI. It's super affordable, and then they even do a fantastic job with like a streamlined refinance later. So the VA does a really good job. You have to have your DD-214. You have to have served for a legitimate amount of time. That can be kind of tricky. What we do is we just get a certificate of eligibility to determine what their eligibility is, because there's some quirks to it, which is not a big deal. We get the DD-214, we submit it. You get the COE, which is the Certificate of Eligibility, and we know exactly what they qualify for. It's pretty slick.
Is there any reason that you can think of that a military person who does qualify, why they would maybe not want a VA loan?
Yeah, there are going to be some reasons where it maybe doesn't make as much sense. Like if they have a down payment, a significant down payment, they may not need to use it. That upfront funding fee is charged, whether they have a down payment or not. So let's say they don't have the disability at all. They don't need to have the VA on there. I mean, it's going to charge them the upfront funding fee for nearly no reason, especially if they didn't need the PMI in the first place, by way of having at least 20% down. So yeah, there's situations where they wouldn't need it.
Okay, so I hear you saying a lot of different type of loans for a lot of different type of people.
Yes.
One of the last ones is a conventional loan.
Yeah.
Talk to me about a conventional loan and who would choose that and why they would choose that.
If you have credit 700 or over, generally the conventional, and you have funds for the down payment, generally conventional is the way to go. It is a smoother process. The rate will be a little bit higher, but you also have the ability to have risk-rated PMI. So this is the part where we talked about PMI being fixed earlier.
Okay.
On a conventional loan, it's not fixed. With American Mortgage, we do risk-based PMI, which means if you have great credit, your PMI is risk very low, which means your PMI quota is going to be also very low. If you're in a credit position where you have lower credit, that risk is higher. So they're going to charge you more for having that higher risk. So this is where having great credit, you get really rewarded out of it, actually. If really low PMI, There's a lot of different levels, like if you put 10% down, 15% down, of course that risk even goes lower, which means that PMI is reduced. So it's just a really good way of rewarding somebody who's had great credit. 3% down is the minimum conventional. There are more than a couple. There's a few products that are really good out there. Home Ready is one of them. That's a 3% down conventional loan. It's really nice. There's some quirks to it, no big deal. We work right through those, but it's still conventional, still risk rated, PMI. And then there's the standard 5% down. That is probably the easiest option. Again, risk rated PMI. Rate is still good based on credit, based on loan to value. So again, how much they're putting down, where their credit comes in. But it really surprises me. People still think you have to have 20% down to do a conventional loan. That is just not the case.
So you're saying that the 20% is just if you don't want to pay any PMI?
Correct.
So you can do a conventional loan for 3 or 5% down.
Yes.
So that's similar to an FHA. You said 3.5% at an FHA. So that conventional loan is for someone with a higher credit score, and their PMI will reflect that as well too.
Exactly. Yep.
Okay.
And so we do a lot of comparisons for people, especially if they're in that little medium range of being close to the 700s or maybe just slightly under. We can run comparisons on as many products as they want, but typically we would be showing them what the FHA could offer versus what the conventional could offer.
Okay. The very last loan type I'm going to ask about is, and you can tell me what this actually is called, but a construction loan. And I'm not talking about a home equity line. Okay. Actually, when someone is either building a house or major renovation, it's a construction loan. Can you do those and tell me what that's even called?
Yeah, we have a renovation loan that we do. It's a 203K product. During the whole COVID thing, they really honed in and narrowed that down, but now they're starting to open that back up again. Also because people are realizing so much equity in their properties right now with the kind of the boom in real estate. So, really the renovation loans, they're picky about what you're renovating. It's not just for like new countertops or, I don't know, something cosmetic in your house. Okay. It's for adding square footage. It's not for luxury items like a pool or things like that. It's truly for, increasing the value of your property by square footage. Or you could do new roof, siding, windows. You could do stuff like that. Those are significant. And then the construction loan, when we just standard construction loan, you do a 2-time close. There is a 1-time close option. It just really depends on who they're using to build, how quickly that can get turned around. You don't want to lock someone at a higher rate. If it's lower, they tend to want the lower rate. Sometimes that 2-time close really works because maybe they're selling a house that they're going to be moving out of and moving in. Construction loans are really, this is what I recommend every time. Just sit down with your lender and go through your whole timeline. There are about 101 questions that everyone will have, and it's really important to go through that to figure out which route is best for them. Super important. So
all of these types of loans, except for that one, are based on a new purchase. Talk to me about refinancing. Okay. I know you do a lot of refis. At what point would it make sense for someone to refinance their loan?
Yeah, if they're at a 30-year and they want to go to a 15, obviously we're 15 or a 20, we're reducing the term of their mortgage. Really, obviously financially, somebody who's financially stable and can do that, really good option for them. Or if they just want to maybe even go from a 10 or a 15 to a 20, and maybe they're taking equity out to do something that they want to their house. They want to go back to the 30. The 30-year rate it's right around 3%. So it makes perfect sense for somebody to refinance if they're over 3.5 at this point. So about 0.5% makes a big difference. Now, what I will also say is, it also matters what their loan balance is. If your loan balance is low enough, we don't just refinance here just to refinance. We'll actually do the calculation for you and show you how many years it will take you to recoup the cost, because there are costs to refinancing. What I hate to see out there are those offers for no cost to refi. Well, what they really do is just book those costs into their loan amount. Either way, it's just not fair to the borrower because their balance is going up. So I think in the end, you just really want to know what the actual cost is. And a lot of people's equity have gone up so significantly that, you can even have a really good shot at not needing an appraisal reducing costs that way. But really just lowering your rate by 0.5% can make a really big difference on your monthly payment. I've seen a lot of people refi lately, obviously because the rates are lower, but they're really interested in putting that money somewhere else. Like they're investing, or they're opening up businesses. Like I've seen things like that, which again, it's their money. It's what they want to do with it. But I've seen a lot of improvements to houses. There have been a ton of windows, siding, roofs, just improvements that way, which I think is just a great opportunity for you to, you have to do those things to your home eventually anyway. So it's just a good opportunity to do that while rates are really low. Also, school loans. People are doing the equity style loans to provide school for their kids. It's kind of neat that they're able to do that. And then just a ton of people going from a 30 to a 15. So financially responsible. They're going to have that mortgage paid off. It's just going to be a relief.
So I heard you say that probably at least 0.5% reduction is what it would take to make sense for the costs. I'm sure there's a lot of people that have never looked at refinancing, and that cost could be a huge saving.
That
It could be 1, 2,
yes,
3%
right.
higher. Talk to me about buying points. I hear people say they bought a point on their loan, or what is that, and why would you want to do that?
Okay. Again, a lot to that question. There's a lot of reasons why it would make sense, and then there's a lot of reasons why it wouldn't make sense. Again, loan balance matters on this one. So the higher the loan balance, the more rate reduction that you have, the more you're going to save in the long term. Okay. So a point can be purchased. It's really where rates are that day. Okay. There's a par rate, which just means like that's where American Mortgage thinks like that this is the standard rate for today without us losing money. So we have a par rate where we really need to be right around. That's the standard going rate for the day. Okay. If you want to be under that, it's the difference from the par rate to that rate. You multiply that by the loan amount. So again, loan amount matters. So let's say it's just an even 1%, and you multiply that by the loan amount. That's the even cost that the point will cost them. So it's not an even amount every time. It could be a half a point times the loan amount. And again, loan amount matters. If you have a $400,000 loan or a $100,000 loan, that's a significant change in cost. So every single person that we go through, we give them their rate. Okay. And if it's a great rate and there's really nothing near it, there's not much conversation to have because it's going to cost them a lot to get down to the next rate. Okay. If the rate is really close to it, we will always tell them, this is what it would cost for you to buy this point down. We do not do that automatically, not to anybody. We just do not do that. That is a trick, I think, that mortgage companies use to always have the lowest rate. But really, I find that I just don't like it. I'm not going to do that to somebody. I'm going to let them make that decision and let them know what the real cost is. But again, over 30 years, it might make a lot of sense for somebody to pay that up front, reduce their rate over 30 years. On the flip side, rates go crazy all the time. Like, what if rates go down again? Then you paid that point for nearly nothing, and you refinanced your rate or your loan in the next year or two, and got a much lower rate, and you really paid that to nobody. So I don't know. I'm kind of one of those people. Like I'm not a gambler, so I don't gamble, and I just go with the best decision when I see it.
Right. I mean, that kind of sounds like a gamble. However, I mean, if you have an expensive home, a high loan amount, and it's your forever home, and you don't intend to move, it might make sense for you. But I know you're not a fortune teller, but talk to me about these interest rates. I mean, they are the lowest that of course, that we've ever seen in our lifetime. But can you tell me why they are so low, and what has to happen for these rates to start climbing back up? I mean, they have to climb back up.
So many things have to happen, and it seems like every day, it's really, depends on mortgage bonds. Where are mortgage bonds? Are they fully backed? The government will always back them. We think the government will always back them, okay? So we've learned a lot over the last year about what the market can really mean for mortgage bonds, okay? So investors need to put their money somewhere. They're going to invest their money in the market somewhere. We want them to invest in mortgage bonds. We want mortgage bonds fully backed. It gives a lot of security. It holds rates really stable. But guess what? That does not matter if the rest of the world is going crazy. So we really have to sit back and just watch mortgage bonds. The 10-year treasury rate is really, really important. Now, that is really complicated for me. That stuff I read it every day just because I think that's my duty to kind of have an idea where it's at. But I have smarter people in my network that I will reach out to and talk with and just kind of see like, hey, should we be floating rates right now? Where do you think they're gonna go? And we do watch that. We watch that every single morning. We get a full report at around 9 a.m. We read it all. It always has to do with the day before's treasury rate and if the 10-year treasury rate is being fully backed. And then you will literally see the scale go back and forth. And a lot of times it'll give us like the green light, like go ahead and lock. Rates are gonna be pretty stable. Sometimes you see it in the yellow where they're like, cautiously float. If you get a really good credit score, something really good, lock it in.
That's interesting.
And then sometimes it's in the red and it's like, hey, hold on, don't do anything with them, just completely float their rate. Today things are going crazy in the market. And again, not a gambler, but I will absolutely read that every single day to kind of have an idea where things are at. And if I have more questions, we have ridiculously brilliant people in this company that will explain it to me in layman's terms because sometimes it gets complicated. So it's really tough, but basically it's all based on the 10-year treasury and if mortgage bonds are being backed.
So one question I have about what you just said was floating their rate or
Yes.
Locking their rate. If you locked someone's rate, you said you're not a gambler, but you can lock that rate in, and then it doesn't matter what happens.
Correct.
How long is that lock usually for, or does that matter?
We pick those, yes. So we pick those. Typically, we pick a 60-day lock just to give way more than enough time. But if somebody's really going to be ready to close pretty quick, we'll do a 35-day lock or a 40-day lock, 45. You can really pick the time frame that you want.
Just to make sure you get through closing.
Yep. I mean, we're closing our loans in a month anyway, but things can happen, appraisals or, maybe somebody needs, just a little bit more time. A lot of people who are moving from this area, I've seen them actually leaving the county, like they're actually leaving. Okay. So they may be in Florida or in another state or something. And so what we really want to do is just be cautious that we don't lock it too soon or for too soon of a close date and maybe they're not ready for it. So you really do need to read your purchase agreements to figure out what does the seller really want? Because we want to accommodate the seller as well. The buyer, of course, they're our client, but at the same time, I want to make sure that we're accommodating everybody. So the lock date does matter. We do take a look at that on their purchase agreement. So floating is where you say, like, we're still going to get your loan done in time. We're just not going to lock that rate yet until that red goes to green or yellow.
Because you really don't think it's going anywhere.
Because it's maybe a crappy rate. Honestly, we could lock them at any day, but maybe it's a crummy rate, and we want to make sure that we get them a much better rate. So that's what floating is.
Okay. A lot of different types of loans, a lot of different types of scenarios for different people. I can't believe that some people try to go through that process alone with an online lender. Do you have a story or a situation that you can share where someone used an online lender at one time that did not come out good in their favor? Tell me a few reasons why someone should choose you over, say, an online lender.
Okay, online lenders typically have very quick online applications. They're trying to be quick and easy. Okay, what that does is that goes to an automated system. They run your numbers, and in general, it looks like with this credit score and this amount of income that you've put in, you would be pre-approved for this amount. Okay. What you just gave them was what you thought you made. Again, salary versus commission. What you thought your overtime was, very different when it comes to averaging those out and following the guidelines. But you've given them what you know best, which is just what your paycheck says or whatever, okay? They don't review those. They go off of what you've given them, okay? Let's say you've just recently taken a new job and you have a ton of overtime and you put that all in there and they qualify you for $50,000 more than you really should be qualified for. You're going to be really sad when they finally verify all of that and they find out that you do not qualify for that. You've made offers, they've given you a pre-approval letter, which is insane to me because it's all automated, it's trying to be fast, but nothing is verified. Then you find out, or let's say you're using like child support for income. And then you come and you document this, and then they look at the actual documents later, sometimes 3 weeks into the process, and you're supposed to be closing in about a week. And they say this is not qualified income. What are you going to do? You're out. Online lenders to me are just no good because really they don't document early enough. They give you pre-approvals before they ever actually take a good look. So the stories are endless. The story, you asked for one story, they're absolutely endless. The bad news is endless. The worst ones are usually people trying to do a VA loan through an online VA lender. That's sad to me. When you tell a vet, what their costs are going to be and this and that, and they go through the process, a lot of times, thankfully, due to local realtors who know their clients and know their local lenders, they will take a look at those costs and go, whoa, like that's outrageous. What are you, like, wow. Please talk to one of our local lenders. The very last one I had was in February this year, and the closing costs were $10,000 plus. Wow. They had points in there that they never told them they were charging. They just said VA loans are very expensive. Okay. By the time I got their loan, I literally looked at it within 15 seconds, and I was like, ugh, I will literally do this for you for less than $3,000 because all of that is bogus. None of that needs to be charged. Yeah, I mean, seriously. And it just seemed too good to be true to the guy, and I kind of felt bad for him. I mean, it's your call in the end, but I promise you these fees do not need to be charged. So we went through, we did the online application with me since he was not in front of me. We were over the phone. It was on a Saturday. I just felt so bad for this guy. And yeah, his closing costs were about $2,900. That's it. And so yeah, he would have gone through and paid that. He had the funds. He would have wasted that money. It's just sad to me because they can add charges that how do you know if they're legit?
People don't know what they don't know.
I know. It's just troubling to see it. It makes me very upset. Like if you're trying, that's just, and they don't know. They don't know what they don't know, and then they get charged, way overcharged. And then, to find that out later, like the feeling of being ripped off is pretty troubling. And so just for me to be able to save anybody that, it's well worth it. So well worth it.
So don't get ripped off. Jess, tell them how to get a hold of you.
Okay, you can call me anytime, 260-273-2230, or email me at jessica.beste, and that's BESTE, at americanmortgage.com.
Okay, and so when it comes to buying a home, do not use an online lender. You want someone to walk you through it and make the best decisions possible.
Yes.
The Jessica Best decisions.
Yeah, I like that.
Thanks.
Thanks.
Yeah.
Okay, would you rather fart in an elevator full of strangers or belch loudly while giving an important presentation at work?
Oh, that's a great one. It had to be fart loudly too.
It did.
Right?
I think that was the specific. No, just said fart in an elevator full of strangers.
I'm farting in an elevator in front of strangers. Yeah. Would you rather take cold showers for the rest of your life or never get more than 4 hours sleep a night again?
I'm going to go with cold showers. I really love to sleep.
Really love to sleep.
I really love to sleep.